Welcome, welcome. When you put your money in a bank account, have you ever really stopped to think about what happens next? I mean, sure, you assume it's safe, but there is so much more going on behind the scenes. So today, we're going to pull back the curtain and find out how banks really work.
Okay, so what if I told you that banks are essentially creating money out of thin air every single day? I know, it sounds like something from a wild internet conspiracy theory, but it's actually the fundamental reality of our modern financial system. Stick with me, and we are going to unpack this whole thing together.
All right, before we get to the financial magic trick, let's start with the basics. The simple promise that we all think we understand about how banking works.
At its heart, it seems to start with this really straightforward business model. On the one hand, they pay you a pretty low interest rate to keep your money with them. Then they just turn around and lend that same money out to other people, but at a much higher interest rate. Simple, right?
And that's the whole game right there. Their profit is that spread, the difference between what they charge for loans and what they pay you for your deposits. This is exactly why they want you to deposit as much as you can, because the more money they have, the more they can lend, and the more profit they stand to make. It's a clean and simple model.
Or is it? See, that simple model, it's not the whole story, not by a long shot. Now we get to pull back the curtain and see the real magic trick at play, something called the money multiplier. The secret ingredient is a system called Fractional Reserve Banking. And no, this isn't some shady loophole. It's an actual rule set by the Federal Reserve. It basically says banks only have to keep a tiny fraction, like around 10% of your deposit, as actual cash in the vault. The rest of it, they are legally allowed to lend it out.
So let's just walk through how this works. Let's say you deposit $10,000. The bank, following the rules, keeps $1,000 of that as its reserve. It then lends out the other $9,000 to someone else. And here is where the magic happens. Your bank account still says you have $10,000, but now someone else has $9,000 from their new loan. Your original deposit just expanded the total money supply in the economy.
That's right. Just like that, your initial 10 grand has effectively become $19,000 circulating in the economy. It's kind of wild when you think about it.
And get this, it doesn't even stop there. When that person who borrowed the $9,000 deposits it into their bank, well, that bank does the exact same thing. It keeps its 10% and lends out the rest. It's a chain reaction that keeps multiplying the amount of money in the system, all without a single new dollar bill ever being printed. Okay, so that whole money multiplier thing, that's the classic textbook explanation you learn in school. But in today's high-speed world of finance, the reality is, well, it's even crazier. It's time to peel back one more layer and see how money is really created today. So we've always been told that deposits create loans, right? You put money in, the bank lends it out. But what if we have it completely backwards? This quote here forces us to just flip that idea right on its head. What if it's the loans that actually create the deposits? And this is how it really works these days. For the big banks, the decision to give you a loan comes first. They just extend the credit, creating a new deposit in your account with a few clicks of a button. The reserves? Oh, they'll worry about that later. They can just borrow them from other banks overnight if they need to.
It's almost an afterthought.
Now, you might be thinking, whoa, wait a minute. If the reserve requirements aren't really stopping them, what's to keep banks from just lending out an infinite amount of money? And that is an excellent question. Let's look at the real safety rails that are built into the system.
So yeah, what is stopping them? If they can just create money so easily when they make a loan, what are the actual brakes on this thing? What keeps the whole system in check?
Well, it really boils down to two key things: profitability and these things called capital requirements. These are the real gatekeepers that prevent the system from just spinning out of control. First up, profitability. I mean, at the end of the day, a bank is a business. It's trying to make money. They aren't going to make a loan if they don't think it'll be profitable. They have to think about their own costs and, most importantly, the risk that the borrower just won't pay them back. A bad loan is a loss for the bank, plain and simple. And second, maybe the even more powerful limit is capital requirements. The best way to think about this is that the bank has to have its own skin in the game. Regulators demand that banks hold a certain amount of their own money from profits from shareholders as a safety buffer against their loans. So the more they lend, the more of their own cash they have to tie up, which directly limits how much they can lend out. Okay, so we've seen how money is created, and we've seen the real rules of the game.
But this all brings us back to what is probably the most important question for you and me. Is my money actually safe in the bank?
Let's just put a number on that feeling of security. $250,000.
This number, this is your safety net. Here in the US, the FDIC, which is a government agency, insures your deposits up to $250,000 per person, per bank. So even with all this complex money creation going on, your personal deposits are protected by a federal guarantee.
So after all that, we've learned that banks don't just hold our money, they actually create it, mostly through the act of lending. And that leaves us with one final really big question to chew on. If the creation of new money is fundamentally tied to debt, to people and businesses borrowing, what does that really mean for the health and growth of our entire economy? Definitely something to think about. Thanks for joining this explainer.